Trump, I love this one. Trump likes to boast the single best measure of the economy is the stock market. I never thought that. Well, if that's true, take a look at the stock market now. It's higher than it's ever been. I guess it's everything's doing well. It is. It's higher than it's ever been. It's higher than it's ever been. It's higher than it's ever been.
All right. Today is Sunday, October 31st. Halloween, baby. So get ready for some spooky action because I got a good one, a big one, and a long one for you tonight. What are you talking about here? I'm talking about the video, of course. But before we dive in, we have few things that we're watching. Number one, the president is in a European tour right now, and he got to meet His Holiness the Pope, and this is what he said. "I'm the only Irishman you've ever met who never had a drink," as he gave the Pope a command coin. And then he went on to praise the Pope as a great Jewish leader. Anyways, we continue to watch the development from the European tour of the president because it ties up to the bill. What bill we're talking about? The infrastructure/debt ceiling bill, which for now, according to the latest news, we're going to have a vote on the floor this coming Tuesday. Of course, the market will be excited until it hears the details. If the details come up short to the expectations, then we got a problem. But for now, here is what we know. Of course, the president is not getting all of his wishes. He's leaving a lot on the table. For example, all of these promises, tuition-free community college, not going to happen. Paid family and medical leave, not going to happen. Clean energy performance program, forget about it. Dental, vision, not going to happen. Lower prescription drugs, not going to happen. 5 years of extended child tax credit, not going to happen. A tax on billionaires' income, of course it's not going to happen. And the investment in child nutrition, not going to happen too. But rest assured, Senator Bernie Sanders, the shittiest poker player ever in the history of poker, he described the bill as by far the most significant piece of legislation ever passed in the world to tackle the climate crisis. Wow. Bernie, you lost. Everything you wanted is out of the bill. What a piece of work. And of course, we continue to watch the situation about the jab mandates in New York City because the deadline is on Monday. They're going to start checking your jab status on Monday. And we have thousands of workers who remain unjabbed and they're going to walk away from their jobs. Trash piles up as vaccination deadline looms for New York City workers. What's new, right? Trash, New York City, they go together. What would the great city of New York look like without trash? It's a national treasure. And then we have thousands, about 10,000 NYPD officers who are going to defy the jab mandate, okay? And then we have thousands of firefighters doing the same. This is going to morph into a massive economic, if not safety crisis in the city of New York. But besides that, let's dive into our regular programming and what we have on the agenda today. And here it is, in focus tonight. We're going to talk about earnings, and then the warning from Bill Ackman, and I have a lot of details for you here. And lastly, market sentiment. We're going to talk about who's buying the dip right now, what are they buying, and what's going on with the mania, specifically the Tesla options mania. I have interesting details for you, so stick around. We start with earnings. What's going on with the earnings we got last week? On Friday, we got earnings from AbbVie and Chevron. AbbVie did pretty good, nailed everything I was expected. We have growth year over year in every single category of the business, with exception, of course, of women's health. This has been a problem for the company for many quarters now, although the numbers are improving as of late. On top of that, AbbVie increased their dividend higher, and this is exactly what I'm looking for. It is a dividend-based investment, and when the company increases the dividend, this is all what we're looking for here. But we have growth across the board, no problems whatsoever for this company. And then we had Chevron, and again, Chevron nailed everything. Their numbers in the upstream and downstream businesses are now exceeding the numbers from 2019. meaning that the business has recovered and the stock remains extremely undervalued. So what is the take here from last week's earnings? We're looking for companies that can survive this inflationary environment. How do you survive the inflationary environment? You survive it by your pricing power and how the consumers, or whether the consumers are receptive or not. From all of the earnings that we got last week, we have these companies that exercised and demonstrated their pricing power. UPS, 3M, Coca-Cola, McDonald's, Ford, Merck, Caterpillar, and Chevron. I own some of these stocks, but other stocks I'm looking at very closely, whether I'm going to add them to the portfolio or not. I believe that this is a bad entry point, but you got to keep these names in mind because they have exercised their pricing power and the consumer remains receptive for now. You can also substitute some of these names with other names that could be cheaper. For example, UPS. If you believe that the ship has sailed already in UPS, you can look at FedEx. That could offer better valuations than UPS. And of course, we have Bill Gates, your favorite. He's also buying FedEx in a market full of wild valuations. Bill Gates holds these stocks for stable income growth. You want to follow some top criminal like Bill Gates because they always know what's going on. He's buying FedEx. He's also buying Walmart. He's also buying Canadian National Railway Company. And Gates' secret weapon, he's buying a ton of farmland. He's the single largest owner of farmland in America. Mr. Gates, of course, is preparing for the upcoming starvation, the upcoming famine. When that happens, you're going to have to beg Bill Gates for food. Or you can hedge that because you and I can't buy farmland, by the way, but we can hedge that by having teenage daughters. And then we can exchange those daughters with Bill Gates for food. And of course, I'm joking here. I'm not accusing Mr. Gates of anything related to the Epstein scandal or anything like that. I mean, after all, Jeffrey Epstein is dead.
Well, he's dead. So, in general, you always have to be careful.
And back to earnings, what about the big cap technology stocks earnings? How do we look at that? I'm going to rank them for you based on the numbers solely. For example, if you hold a gun to my head and say, you got to buy one big cap technology stock, what would it be? And my response would be, are you asking me based on valuations and personal preference, or are you asking me based on the numbers we got last week? If you're asking me about the numbers that we got last week, then here's what's going on. At number one, Microsoft remains the top big cap technology stock. Big cap technology company, and the reason is they continue to grow and they have a diversified business portfolio. They're not tied to hardware or software or advertising versus something else. It's an extremely diversified business. At number two, Google, Alphabet, they delivered for now on the ad revenue, be it the growth is shrinking from last quarter, but the ad business remains attractive for now. The problem is, when it comes to Alphabet, all of your eggs are in one basket, and this is the basket of advertising. Advertising is a cyclical business. If the economy turns sour, so will the ad revenue, and therefore, in my opinion, Microsoft is a better pick than Alphabet. Then at number three, we have Apple. Apple delivered pretty much in every metric. The problem is with Apple, the growth is slowing down. The expectations were high for the release of the iPhone 13, and the numbers did not deliver quarter over quarter. And then we have Facebook at number four. The ad revenue is going down. They have a lot of problems, a lot of scandals, and if the ad revenue is going down, you can distract all you want with the metaverse, but your bread and butter right now is the ad revenue, and this is trending down. And lastly, the worst of all big cap technology stocks is Amazon. The earnings were abysmal, absent of the growth of AWS. Now, if you hold a gun to my head and say, pick one of these names in your portfolio, personally, I already dumped Microsoft, made 40% year to date. I think that's enough. I will pick the most attractive stock in terms of valuations, and this is Facebook. Now, hear me out here. On the short term, continue to watch the options for Facebook. There could be an excitement regarding the metaverse, and that could push the stock higher. In the long term, we have a problem with the stock because CEO Mark Zuckerberg is putting all of his eggs in one basket, and this is the basket of the metaverse. If the metaverse is a bust, then the entire company falls down, and this is the risk you have to assume in investing in Facebook. What if the metaverse is a bust? And of course, if you're going to buy Facebook, please make sure that you buy the right stock because people made the mistake and they bought the wrong stock just because it has Meta in the ticker. Wrong stock. Facebook still trades under the name Facebook. Next, let's talk about Bill Ackman, famed hedge fund billionaire who issued a dire warning on Friday. A quote-unquote wait-and-see approach to raising interest rates creates significant risks given the substantial progress to date on employment and inflation. Billionaire hedge fund manager Bill Ackman said. And here's what Mr. Ackman said in a tweet. I gave a presentation to the New York Fed to share my own views or our views on inflation and the Fed policy. Of course, the Fed invites a billionaire like Ackman. They listen to billionaires, not to the regular folks who are suffering from this inflation, not average mom and pops who cannot afford to buy a home. They listen to Bill Ackman. Bill Ackman says the bottom line, we think the Fed should taper immediately and begin raising interest rates as soon as possible. Bill Ackman is sounding the alarm that perhaps the Fed is behind the curve and they're going to have to push their foot on the accelerator this time around, not on the Coke accelerator, but on the tightening accelerator, meaning tapering more aggressively and perhaps jacking interest rates higher abruptly. And if these two happen, you bet the market will crash. Because, unfortunately, one thing that the majority of you don't understand about the stock market, and I will show you more examples in a second, but what you don't understand is it is not about the money sitting on the outside, the money in the sidelines, as they say. It's all about the money that's already in. If that money is pulled out, then good night, Irene. It's over. Who has the majority of the positioning in the stock market right now? 89%, the billionaires. 89% of the positioning in the market right now is held by billionaires, like Mr. Ackman. And if Mr. Ackman says, I'm pulling out, goodbye, it's over, the bubble busts. The billionaire class watches the Fed's policy more than anything. Not the technicals, not the fundamentals, not the macro outlook, not the policies of the government. They watch the policies of the Federal Reserve. So long as the Fed remains accommodative, we're still in, regardless of the mania, regardless of the valuations, regardless of everything. We're going to continue to hold our noses and watch our gains grow higher and higher and higher. But if the Fed is about to do a U-turn, then we're going to go out. We're going to sell at the top and say goodbye. Mr. Ackman says, we are continuing to dance while the music is playing, and it is time to turn down the music and settle down. What is he talking about by music? We're talking about the Coke and the euphoria / exuberance / complacency in the market right now. And I say Mr. Ackman always has insider information. You people don't know this guy? I do. I met him once in a dream. He has plenty of insider information. And Mr. Ackman, my guess is he's buying a ton of call options on the TBT, betting that interest rates on the 10-year yield will pop higher. And when I dig a little more in the options grid for the TBT, these are the options with the expiration date of February 18th. Notice the 24 calls had somebody buying 10,000 contracts on October 25th. And I say, this you, Mr. Ackman? Bro, because here's what's going on in other countries. You might have watched the reaction in the bond market in Australia and Canada. Both central banks, issued a hawkish stance last week, indicating that the taper will happen altogether and perhaps raising interest rates sooner than expectations will happen. And the 2-year yield in both the Canadian and Australian markets shot up higher. And the assumption here is that the US 10-year yield will also blast higher as the Fed removes its foot from the accelerator, the Coke accelerator, and shifts to the accelerator of tightening. I should actually say the brakes, right? I never heard of a car with 2 accelerators. Anyhow, the brain sometimes doesn't work. And another bad indicator for the stock market, and perhaps supporting the thesis of Mr. Ackman and many other billionaires, by the way. You have the Big Short buying TBT calls. You have Ackman buying TBT calls. You have other hedge fund managers also betting that yields will pop higher one way or the other. Perhaps by shorting the TLT, perhaps by buying financials, perhaps by shorting the growth and momentum names in the market. There are many avenues on how to play this game. But anyhow, as you can see, when interest rates dive down, market multiples, in this case price to sales ratios, expand higher. When interest rates climb higher, the price to sales ratios pull back. If we have a bottom in yields and we're about to head into tightening and interest rates will move higher, then the market multiple from a price to sales ratio will contract. Is this good or is this bad for the stock market? I think you can answer that question on your own, right? And here is just a reminder for you on who Bill Ackman is. Last year in 2020, before the crash happened, somebody bought an enormous amount of put options on the SPY, the S&P 500. 500. And we now know the demand behind the trade was Mr. Bill Ackman.
Scott, I mean, we talk about this all the time on the show, right? We talk about the volatility index and where it's trading, and people are always asking me, well, how do you trade through that read of the volatility index? It's not really through the volatility index itself. I actually go to the spider calls, or puts in this case. So what they're doing today, Scott, is they're going out to February, the February 26th expiring puts this time, not calls. And they're the 320 strike. So they bought about 30,000 of these, paid about $1 for these. Now, the reason this makes so much sense right now is Friday, we were looking at a volatility index. We could call it 20. I think we hit 1999. So call it 20. We pulled back, and today we were actually in the 14. So a big dramatic pullback. That's affected, obviously, the spider, which is the SPY. And that's why I think this makes a lot of sense. This is a very smart trader who's looking to either hedge to the downside, or maybe they've gotten a little bit bearish. To me, it feels more like a hedge. It makes sense to buy it now that it's gotten cheap. We talk about it all the time. Buy when you can, not when you have to. This isn't somebody who's chasing something under a fear move. We've had a couple of days over 400 points to the upside. Today, 100 points to the upside. So this makes a lot of sense that somebody would want to have protection in place going forward. Now, I got another one for you. Gilead. Now, this name's been in the spotlight for a while now.
And then, at the market bottom, Mr. Ackman came out on television, live on television on CNBC, and started crying. The world is about to end. It's over. Marriott or Hilton will go bankrupt. Remember that one? And we now know that Mr. Ackman was buying the dip right there and then. He just wanted to trap more shorts, more pessimism, to buy the market at a cheaper price and force a short squeeze, which will accelerate his gains. And I'm aware that there are some conspiracy theories out there that I'm Bill Ackman. I'm disguising my voice via editing and a fake accent, but I'm actually Bill Ackman. And I say, I'm not Bill Ackman. I assure you, trust me, I'm not Bill Ackman. You can ask my wallet, and she'll tell you all about it. On the bright side, I happen to be younger and better looking than Mr. Ackman.
Why was I born handsome instead of rich?
Moving on to the most interesting story of the day, what happened with the pop in the market? Who's buying the market right now? Because I told you in this channel, we're about to have a reversal. We're about to have a relief rally. It was the easiest buy the dip call in history. The expectations were that the algos will take us all the way to the neckline, and then the market struggles to go higher from there, waiting and anticipating earnings. So what pushed the market higher to exceed all-time highs? The answer is, you guessed it, retail buying of the dip. This time around, though, they might be a little more intelligent than before. The headline from the Wall Street Journal reads, "Swapping GameStop for ETFs. Retail investors ride out volatile markets." What are they talking about here? The U.S. stock market is emerging from one of its choppiest stretches in the past year, a rapid pullback starting in September that sent the S&P 500 tumbling 5.2%, its steepest fall since October 2020. Individual investors were not deterred, bucking an assumption among some analysts that they would retreat once U.S. stocks stopped going up. Even as people returned to offices, traveled, and spent money elsewhere, the so-called retail investors during the third quarter opened brokerage accounts, bought the dip, and traded at a pace not far off the highs seen earlier this year. And again, this will not stop until the Fed tightens. It's not about reopening these geniuses. The reopening will not do anything. People are staying at home because the stock market casino is continuing to work. And it's going to continue to work until the Feds tighten. What changed over the last quarter, though, is what they were trading. Retail investors pulled back from buying shares of meme stocks, swapping them for ETFs. Wow. Wow. They're learning. Finally, they backed off bullish options activity, not for long, of course. Anyways, they backed off bullish options activities. Hold your horses, they came back. Sentiment surveys have also shown the group feeling less confident about the stock market. One October survey from E-Trade found 58% of individual investors believe the stock market will end higher this quarter versus 72% the quarter before. So sentiment is a little down. They say for now, in this report at least, that retail investors are not buying meme stocks and they're not betting on options activities. That came back. Well, wait for it. There are several possible reasons behind the shift. Analysts and investors say prolonged volatility in September likely spooked some investors. A lack of momentum in tried and true favorites such as GameStop and AMC Entertainment Holdings likely weighed on sentiment too. Here's the important part. Where did the mania shift to? Meanwhile, a resurgence in trading of cryptocurrencies and non-fungible tokens, or NFTs, has likely moved risky behavior into other asset classes. Shiba. Data from online brokerage show that individual investors continue to open new accounts. Charles Schwab said this month that nearly 1.2 million new brokerage accounts were opened in the third quarter, roughly double the almost 600,000 accounts during the same period last year. So they're opening more accounts. The mania is intensifying. However, new account growth during the period could not match levels seen during the retail trading bonanza in the first and second quarters. This is when GameStop exploded, during which Schwab added about 3.1 million and 1.6 million new accounts, respectively. Still, on net basis, the total number of active brokerage accounts climbed to 1.3% quarter over quarter to nearly 32.7 million accounts, the company said. Schwab was not the only brokerage to see new accounts during the period. At rival Interactive Brokers Group, the number of individual investors with accounts jumped 10% to 982,000 in the quarter before, the company said. And again, this is the same mania, by the way, that we saw in the dot-com bubble. Everybody hears that the neighbor is making millions of dollars. My cousin Vinny is making millions of dollars trading stocks and trading NFTs and trading cryptos. And now everybody has the FOMO, the open stock market accounts, crypto trading accounts, hoping to score quick money before Christmas. The problem is, trading volume among individual investors has pulled back from the record highs reached earlier this year. But analysts say they have been surprised by how resilient the activities has been. Data from Vanda Research, Vanda Track, which tracks individual investors' trading activity, show that the group purchased a net $24.4 billion of U.S. stocks and ETFs in September, buying billions of dollars in the dip, a period during which markets suffered heightened volatility. That's down slightly from the monthly high of $27.9 billion reached in June. Money fresh out of the printer circles around the people's pockets all the way to the stock market once again. And then the insiders dump, they cash in, and there you go. It's a whole money laundering operation. During the heightened period of volatility starting in September, individual investors flocked to ETFs and some big cap technology companies, pulling into such trades, especially on days when the market dipped. Data from VandaTrack shows. In contrast, they stepped back from purchases of long-time favorites, including meme stocks, EV stocks, and other green stocks. In September, for example, individual investors purchased a total of about $5.6 billion of ETFs on net basis, according to VandaTrack. On the other hand, a basket of meme stocks assembled by VandaTrack saw just $630 million in total net inflows in September versus a 2021 monthly average of nearly $1.2 billion. Here comes the however. However, there have been recent exceptions to that trend, raising the possibility that it could reverse. In recent days, retail investors banded together to drive up shares of Digital World Acquisition Corp., a special purpose acquisition company, aka SPAC, linked to former President Donald Trump. Data from VandaTrack also shows that individual stocks such as fuel cell companies Plug Power have become favorites among the group. And of course, here comes the options gambling mania. We'll look at smaller trades, of course, 10 contracts or less. These are the retail crowds, and as you can see, the options market mania is back. September's volatility did not just bring a retreat in speculative buying in the stock market. Small options traders, defined as those buying 10 or fewer contracts at a time and seen as proxy for retail traders, also pulled back from bullish option strategies. Data according to Deutsche Bank. Individual investors tend to buy bullish call options when they expect the security to rise. This is, of course, perhaps, I'm thinking, before the Tesla options mania. Options data analyzed by Mr. Geoperf perv, whatever, of Sundial showed that small traders spent just 43% of their options volume in bullish contracts in late September, the lowest share since October 2020, suggesting that they may have been feeling less optimistic about the stock market. Wait for it, everything reversed in October. That share of bullish bets has rebounded in recent weeks, with small traders spending 49%. Once again, 49% of their volume buying call options last week, still off from highs reached earlier this year. Recently, many individual investors have begun eyeing a relative newcomer in the space, Shiba Inu. The cryptocurrency has soared 486% in the past month, making it the 12th largest cryptocurrency by market cap, according to the data provider. Its market capitalization surpassed $16 billion, outranking major companies including American Airlines and Ralph Lauren. People are looking for the next thing. If it is not Shiba Inu, they're going to keep going to smaller caps, altcoins, and meme coins. And this is exactly what's going on right now. Shiba is no longer cool. We have another one, the Metaverse coin. And it's going to go on and on and on. Therefore, if you want to trade Shiba or whatever dog shit coin you want to buy, understand that you're getting in for a trade. You buy with a certain profit target, you reach the target, and you say goodbye. If you are in love with the token, I'm Team Doge, Team Shiba, you're gonna get slaughtered. And of course, here comes the perma bears at Bank of America. Bank of America warns the Fed will not rush to stock market's rescue this time around. What do they know, these perma bears at Bank of America? We got the Fed, Jerome. Jerome is in our pocket. He's going to save us again if the market dips. Jerome has our best interest in mind. He will never stab us in the back. I know what you're going to say. But what about the shorties, bro? The shorties are paying. They're covering. That's why the market is pushing higher. Actually, there are no shorts. Nobody is shorting the market right now. The market is going higher due to the stampede. The S&P 500 short bets are worryingly scarce, Wells Fargo says, and you should be concerned too because nobody's shorting the market anymore, and this is a problem. Historically speaking, shorts kept the market in check. Now we have no check at all. The market continues to go higher and higher and higher based on the stampede and the options market mania, meaning that when the music stops, it's going to be one of the biggest crashes you've ever seen in the history of the market. Why? Because all of a sudden, when it happens, everybody will pile in and start shorting the market again. That stampede will amplify the crash. Of course, snakes like Bill Ackman, they're already ahead of time. They know exactly what's going to happen, and they're already betting that it will happen. To me, it feels more like complacency than euphoria. Just the idea that equities are the default asset class of choice. Cash and bonds are so unattractive. That over time can lead to a degree of complacency, or perhaps inattention to risk factors, said David Donabedian, Chief Investment Officer of CIBC Private Wealth Management. And here are headlines that the kids in 2050 will look back at and say, these people were crazy. Shiba Inu and Dogecoin are together now worth more than 388 of the companies on the S&P 500. Just in case you did not get it, the S&P 500 has 500 companies. Shiba and Doge worth more than 388 companies in the S&P 500. Here's another one. Robinhood investors fall out of love with Dogecoin as it drops from 32% of revenue to just 8%. You have an entire platform, Robinhood, that relies heavily in Doge. Doge, nobody loves Doge anymore. Doge is for boomers. Shiba is the new sexy, cool cat. Shiba is not available on Robinhood, and therefore Robinhood goes down. Another headline that the kids in 2050 will look at, Elon Musk's wealth has increased so much you could buy every MLB, NBA, NFL, and NHL team. All of them combined. You can buy the entire basketball league, baseball league, football league, and hockey leagues combined. And of course, if Mr. Musk wants to be a trillionaire, why not list SpaceX in the stock market while the mania is still going on? We will have the first trillionaire by net worth in American history. In world's history, really. Nobody got to trillion before. Here's another headline. We may need to start thinking about Tesla at $3 trillion. I want you to do homework for me. See which countries have a GDP less than $3 trillion. Just do that favor for me. And even Mama Kathy. You know, Mama Kathy, deflation is coming. Forget about valuations, etc., etc., etc. That Kathy. Kathy is dumping. Kathy Wood just dumped another 100 million plus in Tesla stock. Here are the quote-unquote bargain stocks that she likes now. Hint, Twitter, and Robinhood. I think she also bought Snapchat. You know, sell you winners, buy you losers. Classic investing strategy. But you might want to ignore Mama Kathy altogether because what does she know, right? Tesla bull Kathy Wood left nearly $130 million on the table by selling early. You might want to ignore Mama Kathy, but you cannot ignore Tesla insiders. Current former Tesla board members cash in on stock rally. All of these pumps are just a process of wealth transfer between the gamblers and the insiders. Anyhow, folks, we're going to have to cut it short here because we're running out of time already. But I had some good information for you comparing the valuations right now, specifically for Tesla, versus the valuations of the 1999 dot-com bubble favorites, the likes of Qualcomm and Cisco, and even Amazon, and how Tesla stands against all of these. I'm going to cover all of that in tomorrow's video, assuming that the world doesn't explode, so that's the teaser for now. But anyhow, folks, we're moving on to the markets coverage, starting with the market's performance last week, and here we go. The Dow Industrial Average closed in the green by 89.8 points, or a gain of 0.25%. The Nasdaq closed in the green by 50.27 points, or a gain of 0.33%. The S&P 500 also closed in the green by 8.96 points, or a gain of 0.19%. What about the sector's performance? On Friday, leading the pack at number 1 and capturing the gold medal, healthcare. At number 2 for the silver, communication services. At number 3 for the bronze, technology. Meanwhile, the laggards for the day were energy, REITs, and materials. We'll look at the weekly relative performance. At number 1, capturing the gold medal, consumer cyclicals, aka Tesla. At number 2 for the silver, communication services, aka Alphabet. At number 3 for the bronze, technology, aka Microsoft. The laggards, energy, financials, and materials. Not a good week for the inflation trade. It is a good week for 3 stocks: Microsoft, Google, and Tesla. And that was enough to push the market higher. Illustrated by the advance to decline ratios. For the NYSE on Friday, only 39% of stocks were advancing versus 58% declining. The Nasdaq zooming higher. What's going on here? Yet only 47% of stocks were advancing on Friday versus 49% declining. 3 stocks, folks. 3 stocks pushed the market higher. Moving on to futures. What's going on here? On Friday, the WTI crude was up about 0.5 percentage point. Meanwhile, Brent was down about 1%. Interesting divergence here. And then we had a pullback in natural gas. Now, nat gas continues to struggle with the prior highs. Apparently, we have resistance, enormous resistance, in that particular level. Yet it is just a matter of time before natural gas prices climb even higher. What about softs? We had a rally in OJ, over 5% on Friday. I'm still long OJ, betting on the rebound. Here comes the rebound. We also had gains for sugar, coffee, and cotton contracts. On the other hand, a pullback, a reversal of the entire gains that we saw in the week for lumber futures. We also had a down day for cocoa. Metals, a bad day across the board. The dollar popped higher significantly. Tricky Dixie, remember that. Gold down, silver down, platinum down, copper down big. Palladium rebounded higher on Friday, be it from lower levels. What about meats? We talked about meats in the rally in live cattle. I'm in live cattle, and live cattle futures are popping higher. Feeder cattle futures remain flat, while lean hogs futures, the new big tech, also popping higher. What about grains? Gains pretty much across the board, led by canola, oats, corn, soybean oil, soybean meal, soybeans, all working no problem at all. We have wheat and rough rice contracts closing at the flat line. But boy, this rally in oats is absolutely historic. I've never seen anything like this before. I continue to be long oats, and the pitch was we have the lowest crop since the 1800s, and therefore oats prices will continue to surge higher and higher and higher. Moving on to the big casino, the options market. What's going on here? On Friday, the hottest table was Apple, with over 2.3 million contracts. About 72% of those were calls. And at number 2, Tesla, the souffle, with about 1.6 million contracts. About 54% of those were calls. Now, number 3, the ticker LCID, Lucid, also popping higher, one of the top performers last week. About 800,000 contracts traded on Friday, about 73% of those were calls. Watch out for Lucid though, because the IV rank is already at 99% and it appears to be topping for now. But let's talk about Tesla and Lucid options, because here's the headline from the Wall Street Journal. Traders bet Tesla stock's rally isn't over yet. Traders are using options to ride the momentum in Tesla shares. What are they talking about? And you gotta pay attention now. By one measure, activity in Tesla options has surpassed trading in its shares. More than $900 billion in Tesla options have changed hands this week, roughly 5 times the total for its shares, according to the CBOE and FactSet data through Wednesday. That is based on the option's notional value, a measure of how much the shares' underlying option contracts are worth, a figure that fluctuates with daily moves in the stock price. What does that mean? It means options traders, the big casino, they gambled so much that they have exceeded in notional value the actual value of the company Tesla. They traded more in options than there are shares available for the stock. This is absolute mania. So when the Tesla cultists say that Tesla's popping higher because people are buying, or the Berlin Gigafactory, or revenues were good, baloney. It's a stampede in options. That's all there is. Tesla options have morphed into one of the biggest casinos in Wall Street because value of bullish call options can rapidly multiply if the stock advances, as it has for much of the past 2 years. That translates to quicker and bigger profits for trades than if they had just bought the stock. For example, one Tesla call option, covering 100 shares tied to the stock jumping to 900, traded for around 2,800 last week. By Monday, it had more than tripled, according to CBOE data. And as you can see, this is the options grid for Tesla with the expiration date of last Friday. Look at the insane volume and the open interest. Some of these in the open interest, of course. The out-of-the-money open interest expired worthless. But as you can see, the volume is exceeding the open interest in most numbers, in most call option strikes, and this is an indicator that traders closed and booked profits in some of these calls. When we move on to the options grid for the expiration date of this upcoming Friday, it pales in comparison. There are no open interest contracts at all. When we look at the November monthly expiration, nothing, crickets, nothing at all. What does that say? It's a stampede. It's an options gambling mania. Nobody's interested at all in buying the stock. In a nutshell, Tesla stock moved higher because the sheepy next to me is willing to stampede and buy call options. It is a FOMO trade, that's all there is. There is nothing fundamental, nothing technical, and certainly nothing related to earnings that pushed the stock higher. It is an options mania stampede. Now, what does that mean? The sustainability of the pop is tied to the options gambling activities. If we wake up on Monday and people are not buying call options, then the pop stops. If they continue to buy call options, then the mania goes on for a little longer. And this is the same case, by the way, for Lucid Motors. Yes, we have the release of the new 2022 Lucid Air. But remember, this is a company with no profits, with no revenues, with no sales. It's an excellent company. It's a promising leader in the EV arena. Of course, if they scale down their technology and the progress that they've made so far to a more affordable model, then yes, Lucid will be a credible competitor to Tesla. But for now, it remains an exotic car company, and that's all there is. The valuation of the company is almost $50 billion for a company that has no revenues or profits at all. This is the same story with Tesla. They're buying call options with weekly expiration date, creating a gamma squeeze, and then the sustainability of the pop relies on the implied volatility and how long and how much more are they willing to buy in call options. We're moving on to the unusual activities that took place in the options market on Friday, starting with the ticker SPY, the S&P 500. They're buying puts here, insurance trades. They're buying the 380 puts, the expiration date December 3rd, with expectations that the SPY could drop down by more than 17% by then. They paid about 46 cents apiece to enter this trade. All in all, spending about $2.7 million. And here it is, the ticker LCID Lucid. They continue to buy calls with the expiration date of Friday. They bought the $40 calls November 5th with expectations that Lucid could pop higher by more than 8%. They paid about $2.55 apiece to enter this trade. All in all, spending about $8.5 million. So here you have a leading indicator that perhaps the pop in Lucid will continue for a little bit, but continue to watch the implied volatility. If it tops 100%, the mania will be over. The stock will reverse right away. And then we have the ticker NVDA, NVIDIA. This continues to move higher, also by options, call options activities, for, you guessed it, really short-term, weekly expiration, and in this case, for Friday's expiration, the upcoming Friday, November 5th. They bought the 270 calls with expectations that NVDA could pop higher by more than 5.5% by then. They paid all but $1 apiece to enter this trade, all in all, spending about $1 million. And then we have NEO. They're buying puts this time around. Interesting. They're buying the 36 puts for the expiration date, November 19th, with expectations that NEO could drop down by more than 8.5% by then. They paid about $1 apiece to enter this trade. All in all, spending about $700,000. Continuing with interesting trades, what about the ticker AMC? They're buying puts here, the 32 puts for the expiration date, December 17th, with expectations that AMC could drop down by more than 9.5% by then. They paid about $4 apiece to enter this trade. All in all, spending about $2 million. What about the ticker ZEN for Zendesk? I happen to like the name, like the stock in general, but a safer way to bet on a pop after earnings is buying calls. In this case, they're buying the 110 calls with the expiration date December 17th, with expectations that ZEN could pop higher by more than 8% or so. They paid about $4 apiece to enter this trade. All in all, spending about $2.5 million. And what about the trade for the ticker DEN, oil and gas? These are small beta players in the oil and gas sector, and they continue to buy calls on these names with massive pops and massive appreciation in premiums. In this case, they're buying the 90 calls on DEN with the expiration date December 17th, with expectations that the name could pop higher by more than 6% by then. They paid about $5.30 apiece to enter this trade. All in all, spending about $3 million. What about the trade for the ticker TSLA, Tesla? They're buying puts here big time, the 1015 puts for the expiration date of this upcoming Friday, November 5th, with expectations that the name could drop down by more than 9% by then. They paid about $13 apiece to enter this trade. All in all, spending about $7 million. And lastly, what about the trade for the triple Qs, QQQ, NASDAQ? They're buying puts here, the 355 puts, with the expiration date December 10th, with expectations that the name could drop down by more than 8% or so by then. They paid about $2.30 apiece to enter this trade. All in all, spending about $1 million. Moving on to the heat map analysis, what's going on here? Obviously, the market is underperforming all in all, with few exceptions. And these exceptions happen to be large names in market cap. We're talking about Microsoft, we're talking about Google, we're talking about Tesla. All of these names popped significantly higher. Now you could say that Tesla is smaller than Microsoft or Alphabet. Yet the name moved higher by over 22% for the week. This is the equivalent of Apple, for example, moving higher by about 9 to 10% for a single week. And therefore, these three names, Microsoft, Alphabet, and Tesla, held the market for now. Can we see more participation from other sectors of the market? Well, for now, financials not doing so hot so. Oil also pulling back for now. Materials are mixed. Industrials are mixed. The only sector of the market right now that continues to outperform is healthcare, along with consumer defensives. And I happen to be more bullish on healthcare and consumer defensives in this stage of the so-called rally. It started with tech and software. This was back in the summer of 2020. In September, October of 2020, I rotated to the IWM, the Russell 2000, the reopening names. And in January of this year, rotated to the inflationary trade, financials, energy, industrials, and materials. Now, I don't have an official rotation, but I'm noticing that I'm buying more in healthcare and consumer defensives because these two sectors of the market have the pricing power. They can exercise the pricing power, and the consumer have no choice but to continue to buy. And therefore, when we talk about the sustainability of margins, healthcare and consumer defensives have the power to maintain these margins. I also continue to monitor the solar stocks. They have been an outperformer last week, and this is, of course, on the heels of the optimism. The upcoming spending bill will have a lot of solar, EV, green, eco-friendly, whatever, and therefore they're bidding solar stocks higher. Moving on to charts, starting with the SPY 30 minutes chart. What's going on here? It continues to trade within the wedge, and we have a breakout imminent one way or the other, up or down. The support for now remains 454. The resistance is the sky, at least for now, until and unless we get a reversal signal and a confirmation. We get a false one. What are you talking about? I'm talking about the false shooting star pattern on the daily. And here it is, the daily chart for the continuous contract for the SPY. We had the reversal candlestick, and we also had the confirmation after that. The red candle breaking the support of 4,549.5. This was, of course, a bear trap, and the reason is the chart rebounded higher right away. And the problem with this bear trap is it will intensify, already intensifying, the pop higher. Why? Because a lot of shorts looking at the chart saying, you know what, we have a shooting star, we have a confirmation, the support is broken, let's place some shorts, only to be surprised by a pie in the face and the chart pops right back. All of these shorts will have to panic and short cover right away. Now combine the short covering with the stampede, with the options mania. You have the perfect recipe for the market to move impulsively higher. What are the futures doing right now? We have a gap higher. Now this is a continuous contract, and therefore every gap will be closed. So this gap higher will be closed. This is a continuous contract. It doesn't leave open gaps. Now market bears are betting that the extended technicals, the RSI, the MACD, the candlestick pattern, all of that will come together. We will have an excellent reversal signal, perhaps a more reliable signal this time around via gap and crap. You cannot beat gaps and craps because gap and craps, by definition, by the way, are a reversal signal accompanied by confirmation. You have the reversal and the confirmation in one candlestick, the gap and crap. The bulls, on the other hand, are betting that we're going to see another pop higher, another massive candlestick higher, and this will ensure that even if the market reverses after that, they're going to secure the majority of the gains for now. And the next support will be the previous all-time highs versus the current support of 4,549.5, meaning a massive green candle higher will ensure that market bulls will have a buffer before they start losing money if the market reverses to the downside. Moving on to the Qs, 30 minutes chart, what's going on here? We also have the wedge pattern trading in a contracting channel, upward contracting channel. Therefore, we could have a breakout one way or the other. So far, we had false breakdowns and a break higher. The symmetry remains interesting. We have a breakdown and we have a break higher. Could it be false patterns? Who knows? But we're getting at the end of the wedge here. We are anticipating a breakout one way or the other. The support for now remains way down at around 372. We have soft support at around 380. That could hold for now, but reversing this move altogether will be extremely violent, and therefore I keep the support at 372. And here's the daily chart for the continuous contract on the Nasdaq. What's going on here? The technicals are highly elevated, both the RSI, the MACD indicator, the candlestick pattern, all extended. On the other hand, notice the volume. The volume exploded higher in the previous 4 days of trading on the buying side. What does that mean? It means that the dip buying was extremely aggressive in the big cap technology names. For some reason, the retail mom and pops saw the dips in big cap technology names as an opportunity to add, and therefore we have an aggressive energy in buying, pushing the chart higher. We continue to ask the question, is this a bull trap or not? Here's how you'll know. It will be a bull trap if the MACD and the RSI start to pull back and we see a flush down. What does that mean? It means a big reversal candle, let's say a gap and crap, that erases 2, 3, 4 candles, green candles. If that happens, then yes, it is a bull trap. However, if the overextension in the RSI and the MACD indicators are fixed, they curl down and the chart just consolidates. It pulls down for a little bit and consolidates. This will be a sign that this chart is building its way to move another leg higher. It will fix the overextended conditions in the RSI and MACD, perhaps take a little bit of the euphoria and complacency out, and then it moves higher. So once again, two scenarios. Will the pullback result in a flush down candle, or will the pullback result in consolidation? Two different scenarios with two different strategies. Moving on to the Russell 2000. 30 minutes chart. What's going on here? It's building its way higher, yet the chart continues to struggle to break above the resistance of 229. Even though we had an excellent day in the market on Friday for both the Qs, the SPY, the Russell 2000 remains lagging, and therefore I remain hesitant in putting the bull flag on this one and saying, you know what, the chart will indeed break above 229. But notice that the consolidation in the IWM's chart has been going on for a lot longer than the Qs or the SPY. The Qs and the SPY have been blasting higher, straight line. The Russell 2000, on the other hand, has been consolidating since October 13th, at least, meaning that this gathering of energy, the consolidation, this is what it is, a gathering of energy. Will the energy be released to the upside or the downside? I think the answer to the spending bill will hold the answer whether the cyclical side of the market, the Russell 2000, breaks the consolidation to the upside or the downside. And here is the chart for the dollar index, the Dixie, Tricky Dixie. You thought it's dead, right? And it popped higher right away. And it's going to continue to go higher, by the way. Why? Because we have tightening. We have tapering. Everybody doubts that the Fed will taper this week. It will taper. I promise you. Why? Because the billionaires want them to taper. Now, we could see sell the news phenomenon, meaning the dollar reaches all the way to 94.795, and after the news of tapering, the Dixie pulls back. Moving on to gold, what's going on here? We had the channel, and the channel broke to the downside, exactly how I told you it's going to happen. For now, we have the support at around 1,765. This could hold. But again, I'm eyeing 1,685, preferably 1,680, and then we're going to have the quadruple bottom. And to me, at least, it would be a strong buy signal for gold. What about the 10-year yield? What's going on here? The upward channel was broken, yet the chart continues to make higher lows and perhaps higher highs. For now, it is holding. It doesn't want to give up. It wants to move higher, and the assumption should be it will move higher. But look at where the RSI and the MACD indicators are trading right now. They're already at extended levels. They need to pull back to refuel, and then yields will pop higher again. This is the outlook and the assumption, at least for now. Moving on to the TLT weekly chart, what's going on here? We had a decent candle for the week. The negative divergence on the RSI is reversed, and we're waiting for the negative divergence in the MACD to also follow through with the RSI. The confirmation will be if the TLT moves higher, closing the week above 149, and then we will know for sure that there is something else is brewing here. There is more appetite in buying bonds. Perhaps overseas investors are seeing something different. We see the Fed tapering and tightening, and therefore yields pushing higher. Perhaps overseas bond investors disagree. They see the current macro as a warning signal. We have a global slowdown. China is slowing down. Japan is slowing down. Australia is slowing down. Germany is slowing down. Even the US is slowing down, by the way. And this could move investors to buy bonds. But for now, as I said, the outlook remains the same. Yields pushing higher, TLT moving down. Until and unless a technical development happens. Moving on to the VIX 4 hours chart, what's going on here? We had the pop in the morning, but what do you know? The bulls crush the VIX Fridays once again, and the VIX closes at the lows of the day. We're still trading in the green on the MACD from a 4 hours perspective, but it is curling down. So is the pop over? Is the VIX beaten down significantly? Are market participants now more confident that they don't need to hedge anymore because corporate earnings came out pretty good, at least in their perspective? Of course, I disagree. I think the earnings that we got, if anything, they're indicating that the pace of economic growth is slowing down. Now, bear in mind that the Bill Ackman trade that he did last year, he bought SPY puts when the VIX was suppressed. And if we go back in memory during that time, the market was jittery. We had the virus news from China. Everybody was concerned. And the market dropped down for a little bit when the virus was spreading to other territories, when airlines started to cancel some flights. But the market recovered right away to all-time highs. Please go back to those days and you'll see that the sentiment changed rapidly. When the market rebounded higher to all-time highs after a scare, everybody said, you know what, this virus is a China story. It's not a global story. It is contained within China. There is no reason to panic. The macroeconomic picture remains strong. The Fed remains accommodative, yada, yada, yada. At the same time, Bill Ackman took the advantage of the suppressed volatility and the euphoric sentiment, and he started buying SPY puts. And we now know that this trade is one of the top best trades perhaps in the history of the stock market. So I view these suppressed volatility levels as an opportunity to start hedging at a cheaper price, of course. This is the whole point. Moving on to Apple daily chart, what's going on here? We had the pop, the front loading of earnings ahead of time, and what do you know? It was a trap. They bought call options with the weekly expiration date, anticipating that Apple will pop higher after earnings. Well, you already popped the stock higher before earnings. You really think the stock will pop higher again after earnings, after popping higher before? Not gonna happen, and therefore, all in all, Apple pretty much went back to the flat line. Did not do anything at all for the week, and you were better off waiting for earnings, let the dip happen, and then you buy call options, riding the wave higher. But again, this is another illustration that we have a lot of amateur traders betting on options, anticipating that every stock will pop higher after earnings. It doesn't work that way. You want the stock to be suppressed before earnings. You want the surprise to be to the upside. But when you front load the action ahead of time, and the risk shifts to the downside. And by the way, people say, you know what, Apple's woes are due to the supply chain woes, yada, yada, yada. Once the supply chain is over, then you're going to see iPhones selling like hot cake. What if you're wrong, though? What if the iPhone 13 sucks? We have Apple co-founder Wozniak who says, I don't see any difference between the old iPhone and the new one. Perhaps a new color, but that's all about it. So perhaps the weaker iPhone sales numbers are due to the fact that the new iPhone sucks, and there is no tangible upgrade if you have the previous model. Moving on to Tesla, a daily chart, what's going on here? The stock continues to move higher based on what? Options gambling. Notice the volume. It spiked higher for about 2 days, and now it is moving back to normal. This is a bearish sign that perhaps the mania is peaking, but you have to watch out because we've been in a reliable pattern. Every Monday, we have a stampede on Tesla call options. It used to be the so-called Tesla whale doing so. Now we have a lot of retail investors and traders, mom and pops. They are also joining Tesla whale in buying call options on Monday. So long as the options mania continue to go on, then the stock moves higher until the volume retreats and until the implied volatility also reaches extreme levels, and then the chart pulls back. Unfortunately, with a chart like this, you're going to have to view it from the mechanical aspect of the market, not the fundamentals or even the technicals. You have to watch out the options market volume specifically for Tesla. I am eyeing the gap at around 900 to buy perhaps December 900 puts for the pullback to close the gap. It all depends on how the options grid is going to look on Monday, meaning tomorrow. If we see more buying, then watch out, we have higher highs to go. If the volume pulls back, then this was a pump and dump, a little bit of excitement for a week or so, and then the move reverses. Now we have some good fundamental news and we have bad fundamental news. We start with the bad. The bad says Tesla is recalling nearly 2,800 Model Y and Model 3 vehicles in the US over a potential suspension problem that could make the cars more likely to crash. And then we have the good news. Tesla takes top spot in Singapore sedan sales for the first time. New registrations for Tesla exceeded 312 last month. Singapore had 2,243 EVs on its roads at the end of September. Of course, 312 cars pales in comparison with the fake number of 100 or 150 or 250 or a million souffles from Hertz. the numbers are going to continue to go higher and higher and higher. Moving on to tulips, BTC. What's going on here? Losing some energy, but notice that the reversal from extended levels in the RSI and the MACD indicators are resulting in a consolidation. This is exactly what I'm talking about with the Qs. Are we about to see a flush down, erasing a few days worth of bullish activities? That is considered a flush down. Or are we about to see what we're seeing right now with BTC, a pullback and consolidation? If that is the case, then you still have the momentum and the energy to push the chart higher. And the pullback is good because it takes a little bit of air out of the extended technicals in the chart. The support for BTC remains 55,300, the resistance at around 64,899. We move on to Shiba. What's going on here? I shared this chart with you on my Twitter page. We have a resistance and we have a support zone. At the time, the chart was in the debate zone, meaning asking for buyers. Any buyers? Any buyers? If no buyers, the chart goes down to the support zone, asking for buyers. If buyers show up, then the chart moves higher. If there are no buyers at the support zone, then we see the flush down and the reversal of the pop higher. And here is the update. Of course, bear in mind that Shiba's chart trades 24/7, and therefore by the time you get the video, perhaps the chart will be irrelevant. But regardless, the principles in charting remain the same. The chart went down to the support zone, it found support, it found buyers, at least for now. And are we seeing a reverse head and shoulder pattern? If that is the case, then the chart will move higher. Think about it. Those waiting in the sidelines during the debate zone, they have a little bit of hesitancy that perhaps this will be another pump and dump, and this is the process of the dump. Then the chart goes down to the support line and it finds support. This emboldens, psychologically speaking, it emboldens those on the sidelines to pull the trigger and buy Shiba. Lastly, what about AMC? I feel bad for AMC. Nobody loves AMC. What's going on here? Let's start with the the apish outlook. Are we seeing a saucer bottoming? If we have a saucer bottoming, then the chart moves higher and it recaptures 36.5 for support. Here is the bearish outlook though. We already had a rejection. We had the saucer bottoming. The chart went higher and got rejected from 36.5, and therefore low we go to 32. And what could explain that is a live look for AMC apes. They're taking the bananas, they're taking their profits, and let's go to Shiba, bro. Shiba, and the other one, the metaverse coin. And the one after that, and the one after it. And let's continue to chase and chase and chase until the dance floor catches on fire and we all die. Moving on to the conclusion of this video, what do we have on the earnings calendar this upcoming week? Tomorrow we have NXP and Clorox. NXP will be important as a leading indicator for the chip shortage. If NXP says, you know what, the chip shortage is getting better, then we have no choice but to believe them that the chip shortage is easing. Now, when it comes to Clorox, this is easy. It's a consumer staple giant. We know the numbers from last year will not be matched, but are they exercising their pricing power or not? How is inflation impacting Clorox's top and bottom lines? Are they exercising their pricing power or not? Then on Tuesday, we have BP, Pfizer, Qualcomm, T-Mobile, and Zillow. Wednesday, we have CVS. Watch out for this name. They continue to buy calls on CVS. We also have Marriott, Wynn, and Etsy. On Thursday, we have Uber, Skyworks, Peloton, and Square. Of course, if you have a name that is reporting earnings and you don't see the name on the list right now, you can contact me and I will add the name and analyze it for you. Lastly, what about the earnings calendar? This week will be the equivalent of macro porn. And I'm not talking about the regular kind of porn. I'm talking about the hardcore German type. Why? Because we have a lot of data. On Monday, we have the manufacturing PMI. On Wednesday, we have the ADP, plus the services PMI, plus durable goods, plus factory orders, plus, most importantly, the big dog, the Federal Reserve statement and the press conference from Jerome Powell. If the big dog says we're tapering, we're going to have a problem. For now, our expectations are $15 billion a month, which is, in the grand scheme of things, not a big deal. As you've seen, if the Fed takes out $15 billion out, the retail crowd is putting in $29 billion. But if Powell says perhaps we're going to start tapering more aggressively, then the market will panic. On Thursday, we have the initial jobless claims, per usual, and we have productivity and unit labor cost. On Friday, we have another important day, the non-farm payrolls, the unemployment rate, hourly earnings, and consumer credit. A lot of action here, an action-packed week. And I'll be with you every step of the way. But for now, I gotta go and do some trick or treating because it's Halloween after all. And therefore, thank you for watching. Thank you for listening. This is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.